So the biggest question by far that investors in Tesla has is how do you properly value the stock? What price is the right price right now? And is it over or undervalued? So today we will review an investment expert's advice. Brian Feroldi has created a chart that shows that Tesla's auto business is currently in the operating leverage stage of the current business cycle. But Tesla's other businesses like energy, AI, robotaxi, and bots are in the startup stage. So the question is PE ratio the best metric to use? I've got Hans Nelson with us. He's a mechanical engineer. He's got his own YouTube channel. He does deep dives on Tesla as well. Welcome, Hans.
Thanks for having me.
Let's show this information from Brian Feroldi. I've had an interview with him in the past. He's a great financial expert, and he has fantastic charts to explain how things work. Brian has his website at brianferoldi.com, and he helps, really well explain how to properly value stocks and how to think about your financial investments. And this is one of my favorite slides that he has shared, and it's called the business growth cycle. Okay, and he explains that different companies, right, are at different stages. So if you're a startup, you're really all about focusing on sales. You're trying to build a product, to try to create sales. Once you get to growth, then you're trying to increase your profit. And you're self-funding now. You've now hit the mark where you're break even in profits. So you become profitable. And then when you're in the operating leverage stage, you're optimizing margins and so forth. And basically, the point that he was making is that Tesla is in the operating leverage right now for its auto business. But you need to be aware that the other businesses, robots, AI, autonomy, they're all in a startup phase. And so how do you value this company? And basically what he says this is that when you're in a startup, really you don't have any sales, you don't have any cash flow. So you really cannot use these metrics here. That's why they're in red. You don't use discounted cash flow. You don't use PE ratios to try to figure out the value of a startup. You use this to total addressable market. Once you're in growth, you can add price to sales because now you have sales. And then once you get to operating leverage, that's when you can start looking at PE ratios and discounted cash flows. What he's then pointed out, though, for Tesla, the auto business, he believes is an operating leverage, but because in January there was massive price cuts and done purposely, that it was purposely brought down here, back to here. So that's why there's margin compression. People are freaking out about the price, PE ratio, and they're trying to say, hey, the company's stock should be hammered. But this is all in purpose because what's going to happen in the future with both the auto business and all the others. So a quick comment here before I actually show Nick Colas. I want to show him as well of his opinion about PE ratios.
Yeah, and the only thing that I would add, I really like that framing and conception, is just that there are also large pools of different types of investors. And so as you migrate through that different cycles there are entire markets that you kind of open up. And so, there's a lot of more valuation based investors and hedge funds and mutual funds. And obviously, the S&P 500, the NASDAQ, those are companies, or those are indices where you end up getting a lot of cash flow coming into your business if you make it into those indices. And those indices are kind of based on being at certain levels in that thing. And so not only is it, what are the different ways that valuation is assigned, but it's also what are the pools of investors who are willing to invest in you now because all of a sudden these new valuation methods are open.
Let's listen to Nick Colas. It's a very short clip. I interviewed him over the weekend, and what he basically was saying was that that PE ratio is a good way to measure a stock, but it's not the best. Okay. The second good way is the discounted cash flow. You look at the earnings in the future and you discount it to current. But the best way for Tesla specifically, he said, is you need to be looking at it as an options play. So let's listen to his perspective about PE ratios, and then we'll get your opinion on it.
Many people do, and I can understand why. PE ratios are a long-established way of looking at valuations on Wall Street. But at the same time, for example, PE ratios are not really just about the earnings. They're also a judgment about how long the company can make the earnings and what is the return on capital for the company. So if you think about PE ratios, not just in terms of 1 or 2 or 5-year growth, but how sustainable is that competitive advantage? How successful is the company? How much money does it make for every dollar of revenue? That's really what drives PE ratios. It's why big tech, it's why Apple has a over market multiple PE ratio, because its competitive advantage is so strong. Tesla's in a very similar position. Now, one can argue whether a 60 P multiple is right, or a 70 or an 80 or 100. That gets to be a very cloudy conversation, and I don't think particularly instructive. That's why I break it down into the value of the company as a survivor, and then the call option on something else. And we see call option valuation in a lot of different parts of the disruptive tech world. So any cryptocurrency right now is basically a call option on something. For Bitcoin, it's an ETF and financialization and investment merits. For Ethereum, it's the value of smart contracts. So there's a lot of optionality in disruptive technology valuations. And as a Tesla investor, one has to get comfortable with that optionality because it does create volatility. But that's okay. That's just the nature of the beast.
I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com. Yeah, that's why Tesla stock is so volatile, is because most people are still thinking of it as an option play, which means that you don't look at the earnings per se, which many people do, but you got to look at what its potential is going to happen in the future for all these businesses. Comments on that?
Yeah, I really love his comments there because, a lot of the PE valuation metrics that are very standard, most of that thinking and the math and the framework that was developed in comes from earlier in the 20th century when disruptive innovation was something that was much less at play than it is today. And so, you can make assumptions about the way the world works and how to make a safe investment when the world doesn't change that often, that don't necessarily apply in a world where things do change rapidly. And so I think that when we're looking at tech specifically, this is an area where things change rapidly. And so you have to have a different framework. And I like the options framework as an idea to do that because we're making a bet that there's something that is going to, it kind of like goes back to the same startup phase for the Brian Feroldi thing, that you're using assumptions about the TAM of what full self-driving can operate in order to create a value of what the option of whether or not they're going to actually dominate in that marketplace over a time frame will be. And like you said, that is going to be something that is a very volatile options value, because not only are the assumptions around what the size of that TAM is going to be, like those things are going to change. The competitive landscape is going to change. Then the market will assign different value to different people and whether or not they're going to be able to be successful in that. Then also the market conditions change and the economy changes, and that also changes how much people are willing to actually place into bets that are risky option bets versus trying to be more conservative. And so that's the reason why you have so much volatility. The thing that I like about this that's different from options, and one of the reasons I think it's very attractive in the marketplace, is that with options, you have to have your strike date. And this is an option that you get that you don't necessarily have to pick a strike date. You, as an investor, need to decide, what are my time horizons and what do I think the company has to achieve, over certain 5, 10-year, 15-year, whatever your time horizons are. And so it's kind of like you do have a soft strike date that's incorporated in that, but it's not hard, and the option of your or the value of your option doesn't necessarily go to zero unless your thesis is completely invalidated and your company is not actually able to monetize and extract value from the sector that you are actually assigning value to for that option.
Okay. So this is what I love about this. Okay. So Tesla is a amazing company, as we know. Its stock price is very, very volatile. And that's because I think, according to Nick, 50% of the company's value today is based on the auto business, and 50% of it is on autonomy and other options play. I think that's fair. Okay. But what Jeff Lutz just mentioned just a few days ago was that because not only because of this, which is, Tesla decided to do massive price cuts to be able to basically kind of like strategically pressure the industry and the competitors. Of course, he's using interest rates as the kind of the boogeyman of why they're doing that, which they needed to, right? Because low cost provider is critical. But now what it's done is that Tesla's auto business itself could actually be an options play, because as you start watching all of these auto companies capitulate, is the word that Jeff uses, many of them are not going to survive. Or as you saw, you could probably list it out, all these car companies saying that their EV ambitions are pushed forward, they delayed it, they're shutting down plants. And as we come out of the economy in a couple of years, even the auto business could become a massive options play itself, in addition to the other businesses that we're in. Thoughts on that?
Yeah, most analysts are not assigning the 20 million vehicles in 2030 scenario any credibility. And, I think at this point it's hard to say whether or not they will be able to reach that scale, but we do see them continuing to press forward in a lot of the plans. I think that the read of Giga Mexico not opening up fast enough, I think a lot of people are seeing that and they're assuming that Tesla has taken the accelerator off of their growth plans. And I don't think that I think they may have slowed slightly, but I think that they're going to be able to make up for whatever that slowdown was related to Mexico in Austin pretty quickly. And that it's honestly better to do that where you have your engineering staff anyways. Um, and so if you see, the companies that are going to come out of whatever the economic hardships are that we're headed into, the best are going to be the ones that are able to maintain their momentum and not delay their plans like all these other companies are. And so, when I look at who that is, it's Tesla, it is Hyundai, Kia. Apparently, they continue to invest aggressively and put out new models, and then also the Chinese. And so, in that landscape, I think a lot of auto analysts are having to reevaluate who is going to have what market share in 2030. And, obviously there's going to be assumptions about what the total penetration of EVs is at that point in time. But one of the nice things about these companies that had plans that are now scaling them back is that there were investments that were made into the supply chain, into raw materials, that those things have begun. And now the people that were planning to take advantage of those raw materials are scaling back. And that creates a great opportunity for the people who are aggressive and moving forward now to eat up that supply and maximize their growth into the future. I think, like we said, Tesla, Hyundai, Kia, and the Chinese are really in a good position to take advantage of that.
I love it. You always bring up great points. That's probably just one example of something that, because of the kind of retraction of many car companies, and that leaves it open for Tesla. So, wow, isn't it amazing, right? People will think we're pretty depressed with the stock price today with Tesla, but the fundamentals are strong, if not even stronger. And once the macro flips, with the price cuts, and they're able to control their margins and cost savings, Tesla's going to emerge out of this greatly. Thank you so much, Hans. Follow him on his YouTube channel, Hans C. Nelson, and he's also on X, the same name, Hans C. Nelson. Thank you, Hans. Thanks, everybody. Bye-bye.
Always a pleasure.